this week's life skills class, we are going to be learning about health insurance. And to teach you is my mom, Melissa. She's an Aflac insurance agent. Aflac County knows her as the Aflac lady. So if you would take that.
Okay. So as she said, my name's Melissa Hamrick. I primarily do supplemental insurance through Aflac. If there's time, I'll touch on that. But part of our field requires us to know some of the basics of how health insurance works. And we all know that that can be kind of a convoluted and hard thing to understand. So I try to help a lot of my clients understand that as well, so that they understand how what I do fits in with their health insurance. So that's just what we're going to touch on today, is just a few basic things about most health insurances that will help you understand how it works. Most of us have probably a health insurance through our employer, and they're oftentimes called like a commercial health insurance or a group health insurance. And because of that, when an employer does that, that also provides a good, like a discount through the insurance company. So the first sheet that I have that you'll be able to see in the attachments is called Keywords and Definitions. So I'm going to go over a little bit of this just so you kind of understand what some of them mean, and then you can refer back to that as we go through a few sample health insurance plans so you understand what they are. So the very first thing that I have listed on here is called benefits. Like I said before, most of us probably have a health insurance through an employer, or we might be on a parent's health insurance through an employer. So benefits are a form of perks or compensation that are provided to employees in addition to their base salaries and wages. So other examples of benefits might be vacation time, bereavement time, bonuses, and then health insurance, life insurance, things like that. So, and then health insurance by definition is just a contract that requires a health insurer to pay some or all of your health care costs in exchange for a premium. The premium being what you pay out of your paycheck, okay? And your employer also contributes towards that as well. When it's an employer that's providing the health insurance, by law they do have to actually pay 50% of the individual employee's premium. That's the law. They can contribute more, but if they do, that's by their kindness at that point, okay? Carrier is another word that you will often hear too. That's just the company that provides your insurance coverage. You've probably heard of a few of them: Anthem, Cigna. I can't think of a few more off the top of my head, but well, that's more health car insurance. But yeah, State Farm could be another example, but they're more car. Yeah, P&C is what we call them, property and casualty, which would be like your car insurance and homeowners insurance, renters insurance, things like that. So yeah, that's the carrier. Insured is you, the one who is covered by the insurance. And then there's dependent, which is a person who is eligible for coverage under a policyholder's insurance coverage. So for example, Victoria's dad has health insurance through his employer. Me and her brother and her older sister are all considered dependents because we are covered by his insurance through his carrier, or through his employer. And then provider is just your doctors and your hospitals that provide the healthcare services to you, the insured. Okay? So now we're kind of going to get into a little bit more of the details of definitions and words that are actually in the health insurance plan. So the first thing to note is called in-network. Okay, you sometimes hear somebody talking about a doctor or hospital being in-network. That just means that it's a doctor or hospital or other provider that accepts your insurance. Okay, then there's the opposite of that, which is out-of-network. This is when a doctor or facility has no contract with your health plan to use your insurance. There's still some coverage there, but it often tends to be much less coverage versus in-network. So that's why sometimes kids, you might hear your parents talking about seeing a doctor that's in-network is so that they get better coverage versus somebody that's out-of-network. Okay, copay. Yes,
could
question?
you explain how to tell if the doctor is in-network versus out-of-network? Like, how would a person find that out?
great question. So a lot of companies tend to have like a website that you can go to and search your area. You can either search from your house, you can search by a city, or you can even search by a specific doctor or facility name. So for example, for our health insurance through her dad, we have Anthem. And they have an app called Sydney app. And I use this frequently to look at, somebody that maybe we've not been to before to see if they're in network, and it helps a lot to let you know that they are in network or out of network. Okay, great question. Okay, so now we're kind of going to get into a little bit about the actual coverage part and some of the definitions of those words. So the first thing that you probably have heard a lot of is copay. A copay is a fixed amount that you pay for a covered health service. So for example, you might go to see your regular doctor because maybe you're sick, and then you have a set amount that you pay. Like for example, on our plan, we go see the doctor here in town, and it's a $20 copay each time, okay? Sometimes that copay might vary a little bit too, versus your regular doctor and a specialist. Maybe a specialist might be a little more. For example, on our plan, it's $30 to see a specialist, somebody that specializes in a specific area of healthcare, okay? Then there's other things that can happen that actually get applied to what's called a deductible. A deductible is just an amount that you pay for covered health services before the insurance plan starts to pay. So a great example would be like maybe you have to get an x-ray at the hospital. And when your hospital bills the charges for that x-ray to your health insurance, that bill, the total amount, gets applied towards your set deductible, okay? So that set amount. So for example, on our plan, individual deductible is $700. So the first $700 of health bills, health insurance bills, or healthcare bills, I'm sorry, is our responsibility out of pocket. Now, once we've hit that $700, something else happens called co-insurance. So then the insurance starts to kick in and pay something. And that can vary on each plan along with the deductible. On our plan, for example, once we hit that $700 deductible, then the co-insurance of 80/20 kicks in. What that means is after the first $700, the insurance will start paying 80% of the medical bills, and we're responsible for 20%. Now, that does have a limit, and that limit is called a maximum out-of-pocket, or MOOP for short. That just means that that is the most you have to pay for covered services in a plan year, and we'll come back to plan year in a minute. So on our plan, I talked about the deductible is $700. Then the insurance will start paying 80% of our bills until we hit a total of $2,000, okay? So once we hit that $2,000, every bill after that and through the end of the year is covered 100% by the health insurance, okay? So basically, as a whole, health insurance is just meant to limit how much your out-of-pocket responsibility is for medical bills when something happens, okay? Let me give you a great example. So last year, Tori got sick in April and ended up in Parkview for 5 days. Because of our health insurance, we only had to be responsible for a maximum of $2,000 out of pocket. And before the health insurance did its thing, her total bills were over $33,000. So to put that in perspective, if we didn't have health insurance, we would owe Parkview over $33,000 right now, okay? But because of that health insurance, we only had to worry about $2,000. And then once we had that $2,000 paid, any medical bills that she had from April through the end of the year, December 31st, were covered 100% by the health insurance, okay? So that brings us to plan year, okay? So plan year is talking about how long the plan is for the health insurance, for the renewal, basically. And most places, most employers typically will have what's called an open enrollment in the latter half of the year, usually about October, November, December. That's where you're allowed to make changes to your health plan, any coverages that you have through your employer. And then that's set to take effect January 1. So that's the plan year then. Once you've made your changes, they take effect January 1 and they're good through December 31st. Now, not all employers do this. Majority of them do, just because that way it falls in line with your deductible resetting. Because the deductible always runs January 1 to December 31st, no matter what. That never changes. So that's why a plan year will run in a similar fashion to the deductible, so it makes it easier for everyone to remember. But they're not required to. For example, in my husband's work, they do their open enrollment in July every year. So their plan year actually runs August 1st of this year till July 31st of next year. Okay, but that's just the plan year. So this next month in July is when he'll have the opportunity to make changes to the insurance if we need to. But his deductible, or our deductible, is still January 1 to December 31st. Okay, making sense so far? I know it's a lot, but trying to keep it simple. So the plan that I was just talking about for us, $700 deductible, $2,000 out-of-pocket max, that's pretty low. It's very low. It's a good plan considering, you know, some of the other ones out there. Now there's plans out there that are called high deductible health plans, or HDHP for short. And what that means is it just has a higher deductible than a traditional health plan typically does. And then on this sheet here, I have some examples of some health insurance plans. And you can see under Plan A, that's the plan that I've been talking about, the in-network benefits. That's what we have, okay? So if you look at Plan C, it says HDHP on it, okay? It's because it has a high deductible. So the annual individual deductible, so per person that's covered on the plan, is $2,800. So what that means is that when something happens and it gets billed to your insurance and they're in network, you're responsible for the first $2,800 out of pocket. And then the insurance will kick in and start paying 80%, and you have 20% that you're responsible for. Now, that's limited up to $5,500 on that plan, okay? And that's the individual one. So typically, because of that higher responsibility that you have out of pocket, oftentimes those plans also encourage you to set something up called a health savings account, or HSA for short. This is just a type of savings account that lets you set aside money on a pre-tax basis for qualified medical expenses. So let me just kind of back up a little bit. Pre-tax, what that means is when you're contributing to the HSA out of your check, that money comes out of your gross pay, so before the taxes due, okay? And then the taxes come out, which is actually a good thing, because then when you're having things like your benefits pre-taxed, then that's less money that's getting taxed, less taxes you pay the government, okay? And then for qualified medical expenses, that just means that the HSA defines a list of certain things that you are able to use those funds for out of your HSA, and then there is a list of things that you cannot. Just as an example, over-the-counter medicines, or OTC, like Tylenol or ibuprofen, Band-Aids, those are all over-the-counter items, so those would not qualify to be used for the HSA funds. However, co-pays, deductibles, your co-insurance, medications, your copay on medications if there is one, you can use that HSA money for those expenses, okay? Then last but not least is explanation of benefits, or EOB for short, okay? So when you do have something that you go see a doctor or a hospital for, and then they bill your insurance, after they process it, your insurance sends you a statement or an EOB that describes what costs it covered for the medical care or products that you received. So it breaks it down for you so you know where you're at on your deductible and your out-of-pocket max throughout the year. Okay? So I know that's a lot of terms, but anybody have questions so far? Okay. So as I was talking about before, I had a few samples on here of the different things that are covered under the health plan. So if you look down a little bit, called office visit / exam. So it says $20 copay. So that just means that that's when you hit, or when you go to the regular doctor, it's $20 copay under plan A. If you go down to plan C for that same thing, it says 20% after deductible. So on a high deductible health plan, it can be a little bit different. Sometimes you might have a copay and sometimes not. On a high deductible health plan, if you don't have a copay for the regular doctor visits, then what that means is anything that you have, doctor visits, hospital stays, things of those nature, actually all go towards your deductible first. So you're paying out of pocket for everything until you hit your deductible. In this case, $2,800. Once you hit that $2,800, then the co-insurance kicks in and insurance starts paying 80%. Okay? And then once you hit that $5,500 maximum out of pocket, then insurance covers everything 100% until the end of the year. So you can see there's a big difference in some of these plans, especially on the high deductible health plan. So if you get a job and sometimes maybe they only have one health insurance plan available, it might be a high deductible health plan. So at that point, if they have an HSA plan available, it's very recommended to pick that up. Because the other thing with HSAs is maybe you're a very healthy person, so it's going to be typically fairly low cost for you to have the plan and then contribute to your HSA, and that money just builds up, and it carries from one year to the next. So it's your money, and if you ever leave your job, you take that money with you, okay? Versus an FSA, which is a flexible spending account, you put money into that, but the thing is you have to use it or lose it by the end of the calendar year. That's the difference. So I personally prefer HSAs over FSAs, but FSAs can also be pretty good depending on, you know, if you use it a lot. If you use it a lot, then FSA might be something you can use as well.
Now, do both of those, they have to be provided by your employer, correct, to be able to use them?
To get the pre-tax benefit, yes. Now, if you have a high deductible health plan and they don't offer an HSA, you can go to your local bank and talk to them about an HSA plan to contribute to. You just don't get the pre-tax benefits like you do when your employer is deducting it for you. But you can still contribute to that HSA with your bank. And you also have to talk with your bank too, because of some of the rules and regulations with HSAs in correlation with the IRS, there is a maximum limit that you can contribute to that per year, okay? And there's one limit for just an individual, and then there's a limit for family, okay? Good question. Okay, yeah, and then on the rest of them there, you can kind of see how it varies, you know, from one to the next, plan A, plan B, and plan C. And it also breaks it out for out-of-network benefits too. So when you look at a plan, you can compare the in and out-of-network benefits, and you can see that it's definitely a lot more beneficial for you to go to a doctor or hospital that is in the network for your health insurance. So definitely got to try to do that. And like we talked about before, you know, a lot of the health insurance carriers will have like a website or app that you can go to look in your area or look at a specific doctor or group of doctors to see if they're in network before you go. Okay? Any other questions? Okay, great. So getting out of the health insurance into dental and vision, usually they typically are part of the benefits package with the health plan, not always. It just depends on what your employer chose to do, okay? But they do have some similarities in what they cover with health insurance and some of the same verbiage, okay? So for example, on this dental plan that I have an example of, there's just one plan here, and there's in-network and out-of-network benefits. So of course, when you look at it, for the just general information like the annual deductible, and things like that, most of it and the preventatives are pretty much the same, okay? There's not a lot of out-of-network difference on this one, but a lot of times, more often than not, you'll see on a dental plan that the out-of-network benefits are a little bit less than what the in-network are, just like on a health insurance plan, okay? But on this plan, we'll just look through the in-network. There's an annual deductible of $50 for individual, and then that's capped by a family max of $150. So basically that just says that no more than 3 people that you have covered on your health insurance or dental will have to pay a deductible. For example, we have 5 people on our plan, so at the dentist, only 3 of us at the most would have to pay that $50 deductible before the other benefits kick in, okay? Now on dental plans, there is a limit on what is covered per year in benefits. So on this plan, you can see annual plan maximum that says $1,000. That's typically per person that's covered on the plan, not the family as a whole. And also on this one, preventative services do not count towards that maximum. So preventative services, let's get into that because that's the next section anyways. So this is where you go and you see the dentist twice a year, which is what the dentist recommends, to get your teeth checked, cleaned, make sure you don't have any cavities, everything's healthy, because oral health is just as important to our regular overall health. If there's things going on in your mouth, it can affect your internal organs as well. So definitely still just as important as health insurance, and you want to make sure you get to those semi-annual visits. When you go, they have all of those visits there, like an x-ray once per year, the cleaning and such. Those are all 100% covered because they're considered to be preventative, to make sure that you catch something early to prevent major issues. So any of those don't count towards that $1,000 maximum on the plan. The things that do count are the next 2 sections called basic services and major services. Sorry, I think I have to sneeze. Okay, it passed. Sorry. And it's just the same layout as it is on the health insurance plan. Excuse me. Once you pay your deductible, then the insurance will kick in with its part there. But of course, capped out at the $1,000 limit that the insurance plan is going to cover. Okay. Any questions for that one? That one's pretty simple. Okay. And then on the back side, even smaller, but still just as important, is an example of a vision plan. We're all supposed to go see the eye doctor at least once per year just to see if our vision has changed, especially those of us who wear contacts or glasses. I recently went to the eye doctor and found out both my eyes had changed for the better versus the last 10-15 years. So I had to change my glasses and my contacts at the same time. Got a little pricey, but the insurance helped cover quite a bit of it too. On this plan, the eye exam just states that insurance will cover 1 every 12 months, okay? And when you go, it's a $10 copay. Then on frames, which would be, the glasses that you wear that hold your lenses, you can get those once every 24 months, so every 2 years on that. The insurance will cover up to $130 of the cost, and then the difference, 20% off of that remaining balance. So for example, let's just say that you buy frames that are $150. The insurance is going to cover $130 of that and give you a 20% discount off of the remaining $20. So 20% off of 20, that would be, I can't do my math here. That'd be $4 off. Yeah, $4 off. So you would have $16 towards the frames, okay? The lenses themselves are a separate thing, but on here, it's a $25 copay, but you can get new lenses every 12 months, Okay, so for example, when I went to the eye doctor previously and both my eyes had changed in prescription, I didn't want to get new frames, so I just paid to have new lenses put on my existing frames at that point. Okay, so I just had a $25 copay plus my $10 copay for those two services. Okay, now contact lenses are a whole different thing too. And unfortunately, when you go to the eye doctor, it's typically one or the other as far as what the insurance will cover towards. So if you have to get both like I did, because I get more contacts each year when I go for my annual exam, I had to pay a little extra out of pocket towards one of them because of that stipulation for one or the other, okay? So there's a difference between medically necessary and elective contacts. Mine are not medically necessary, so they're considered elective. And they're covered once every 12 months. So if I just only had to get contacts, they would have covered $130 of the balance and then 50% discount off of the difference. Okay? And of course, same thing, in-network and out-of-network benefits are different. So you can see that there's definitely a difference there on the out-of-network, less coverage, so it definitely behooves you to look at the in-network eye doctors and make sure you go to somebody that's in-network. Okay? Any questions for that one? Okay. So, last couple of things that I kind of just want to go over. I don't have anything with me necessarily, they're pretty basic things, but one thing I like to always cover with people is talking about life insurance. There's a lot of different things out there like universal, term, whole life, juvenile, things like that. I'm just going to focus on just a couple main ones, specifying the difference and then what purpose they serve. So in life insurance, there's whole life and term life are the two main ones that I typically work in. And term life, what that means is it's for a set amount of time. So maybe like 10 years or 30 years, 15 years or something like that, okay? Those are more helpful for what we call chapters of life. So for example, maybe you buy a house and you have a 30-year term mortgage. You might buy a 30-year term life policy for the same amount as your mortgage. The reason for that is so that if, God forbid, something happens to you, your surviving spouse or significant other or family member that you leave that life insurance policy to would have the money to pay off that mortgage and then continue to live a comfortable life, especially if you have children. Because when you lose somebody, that's also a loss of income in that sense, okay? Now, whole life is basically that. It covers you basically like your whole life, okay? One of the plans that I sell covers you to age 101. Now, the neat thing too with whole life is when you purchase a life insurance policy for a set amount, you also build something called cash value, or kind of like an interest, if you will. So it's good to do a whole life policy because that's going to be more in terms of your burial money when you someday pass away, unfortunately, because we all, have a limited time on this earth. But you want to be able to leave something for your family to be able to cover those funeral expenses because it's unfortunately very expensive to die. So it's a good idea that the younger you are, the cheaper it is. Also, the younger you are, the more healthier you are, so it's easier to get life insurance because oftentimes life insurance will also have what's called underwriting questions. They're questions about your health, any pre-existing conditions, any felonies that you might have, because those are considered to be risky behavior, okay? So it's very good to get a whole life policy when you're young. Or if you have children, get juvenile life policy, a whole life policy on your children because, again, the younger you are, the cheaper it is. And when they're young, they're healthy, so then it's easier to get. And when you keep that on them, then that just keeps building up that cash value over time. So it's a good idea to have that because typically when you buy a life insurance policy, you're usually, for the most part, locked into that rate. Even after you buy it and you have more birthdays, you're still at that same rate for the entire life of that policy. Okay? And then last but not release, I talked a little bit about that I do a lot of my insurance work through Aflac, which is a supplemental company. I know many of you know the duck, but a lot of people don't typically know how the supplemental works. So supplemental is actually just as important as our health and life insurances. The reason for that is because it helps to kick in some places where the health insurance doesn't. So for example, maybe you have a health insurance through your employer, so that helps cover any off-the-job injuries or illnesses that you may have. And let's just say, God forbid, you do get sick and you end up in the hospital. Well, you're also missing work at that point. Missing work means you're losing income because your employer has no obligation to pay you anything if you're off work for an off-the-job injury or illness. So one of the things that Aflac helps with is called short-term disability. That has to do with supplying you with some of your paycheck so that you can pay bills at home while you're off of work with an injury or illness, and then that way you don't have to stress about paying those bills. Some other things too that they help with, there's specific things for paying for accidental injuries. There's also a specific plan for cancer diagnosis, because unfortunately 1 in 2 men and 1 in 3 women will be diagnosed with cancer. In our family, there's already 2 women in our family that are breast cancer survivors. So it's a very, very crazy statistic to think that, that few number of people in that sense, that ratio will be diagnosed with cancer. And also, currently, the typical cancer diagnosis can cost a minimum of about $46,000. But it also depends on the treatments involved and whether the health insurance even covers those treatments. Sometimes a cancer diagnosis can top into the millions because of the costs involved with it. So it's a good thing to have cancer coverage because also it encourages cancer screenings. There's a wellness benefit that you're encouraged to claim each year by going and getting a cancer screening. Us women, we have to go in for our annual exam. Men should be going in for a prostate exam. Because with cancer, the best way to fight it is to catch it early. So that's one of the things too that Aflac is known for is their cancer policy. And that's just a few examples of what they do. And when you have those policies with Aflac, the difference between them being supplemental versus the health insurance is on the supplemental side, it pays you directly as the policy holder. So that's money in your pocket for you to use what you need to. If you want to use it towards the co-pays and the deductibles, the out-of-pocket maxes, you can, but you're not required to. And we don't require you to do that either. Another great thing then is that, maybe you need to use that money to help with some bills at home, like your rent or mortgage, your utilities, car payment. Those are things that you really can't make payment arrangements on, and they don't wait for us to get back to work. So it's always a good thing to, look into any supplementals that your employer has as well, because while yes, it's a deduction out of your paycheck, but in the long run, when something happens and you're out of work because of an illness or injury, it's going to really go a long way to help keep you afloat financially. Okay? Any other questions? Okay. Hopefully I broke everything down okay. I do have business contact information that I can share that will be in the comments of this video. That way, if you have any questions, feel free to reach out to me. But I will go ahead and give my business number. It's 260-209-4898. And that is my business cell phone number. So if you want to text me first, that's fine. I know we're in technology area, so it helps me too that if you just text me first and let me know who you are and that maybe you saw this video and you just have some questions that you would like some help on. Or if you're looking for some sort of a coverage, let me know. I'm always happy to help. Thank you.
Okay, so our next class will be July 10th, and Mr. Egley will be coming out. Blech, I just choked. Mr. Egley will be coming out and teaching about car maintenance. He will be talking about changing a tire and changing your oil, how to know how to deal with your car if it breaks down or something. So 11 a.m. at the Riverside Center if anybody is interested on July 10th. So hopefully we'll see some of you there.